We previously looked at the first in, first out system, or FIFO. Let's look at some advantages and disadvantages. So before we can sort of begin that discussion, let's just go over again what FIFO is. It's just an assumption. It's actually probably not going to be right in every instance. In fact, it mightn't be right ever. All we did was assume that if 3 units were sold, there's actually very little chance it probably in reality would be these 3 units. I guess the point is though, does it really matter? Why don't, instead of wasting time and figuring out exactly which unit was sold, why don't we just actually assume that it was the first 3? And that was basically the crux of FIFO. It could have actually been those 3. So if FIFO is not always right, why are we going to use it? And the reason is it's got some advantages. So one is it saves time and money spent calculating the exact cost of every sale. Why waste time figuring out the exact cost of sale? You know, we could have thousands of items at the back. So for example, if we were a supermarket selling chocolate bars, you imagine all the chocolate bars in the aisle. We don't know exactly which one cost what. They won't all be identical. Does it really matter? We'll just assume the ones that were first in were first out, and that's going to save us a lot of time and money. That then simplifies the cost of identifying the cost of sale, and what that does is it allows the owner and the business to worry about other things that are more important. You don't have time to waste spending trying to figure out exact cost of sale. It makes much more sense just to run the business and use an assumption that first in, first out. And the reason why we can kind of do this is, isn't it all going to balance out eventually anyway? If we sell all the stock and we applied FIFO, eventually the cost will be identical no matter whether we had have actually gone and figured out the exact cost of every sale anyway. And for some businesses, it might not actually be possible or practical to identify the actual cost of sale, e.g. a petrol station, and we'll talk about that in a second. Our last advantage is FIFO is actually going to increase net profit in the short term during times of rising stock prices. So we'll have a look at that one as well. Let's look at this advantage where we said it might not actually be possible to identify the actual cost of sale. So let's say we were running a petrol station. We've got our petrol tank underneath the earth here. Got a couple of bowsers for customers to fill up in, and then on the left we've got a little port where the fuel trucks can come in and dump the fuel. So let's say one day a fuel truck comes in and delivers 1,000 units into our fuel tank at 72 cents each. And then another day, the fuel tank comes in and delivers 1,000 units that cost 68 cents, like so. And then thirdly, on December the 3rd, we get another 600 litres of fuel delivered, and they all cost 70 cents each. So what we've got is, in reality, the fuel isn't sitting there in a nice little, it's not segmented like that. The laws of physics say that the 70-cent petrol isn't going to sit neatly on top of the liquids underneath it that were 68 and 72. We just got one giant pool or tank of fuel there with 2,600 litres of it. So that's how it sits. So let's say we sell 1,300 litres of fuel the next day. Which litres are actually sold? Is it the 72 cent, the 68, or the 70? Well, it's actually physically impossible to figure that out. And FIFO assumes that it's just going to be the ones that were in first. And does it really matter? It probably doesn't. So what we'll do instead is just apply FIFO. So the ones that were actually sold first are the ones on the bottom there. Or sorry, the ones that were bought first will be the ones down here. These are 72 cent units, they came in first, so we'll just assume that any petrol that gets sold first must be those. But that's an extreme example for fuel. Other examples could be the chocolate aisle in the supermarket, fruit and vegetable store, or the individual units. It's almost impossible to identify exactly which unit costs what. And also any clothes store, because clothes get thrown all over the place, they get messed up, and we don't know the exact cost of every single item. We just can take an assumption that the first one in was the first one out. Looking at this advantage, this is quite difficult to explain, but FIFO will increase net profit in the short term in times of rising prices. So what we've got here is business A has 6 units of stock, and they came in this order 10, 10, 10, and then 20, 20, 20. So the oldest stock is up the top here. So this unit was bought first, and this one, and this one, and this one down here eventually was the last one that was bought. Now, same for business B. They bought the stock in the exact same order. So under FIFO, which is what business A is going to apply, we're going to assume that the first one in is the first one out. What about if we applied, say, LIFO, which is last one in, first one out? And we're going to have a bit of a difference here. So let's say one unit was sold and we sell each unit for $30. So business A for one unit, that's a sale of 30. That's a cost of 10 because we assume it's the top unit, and a profit of 20. For business B though, the sale is $30. The cost will be a little bit different. If we're going to apply LIFO, we're actually going to start down here. So what we'll assume is the cost of that sale is 20. That leaves a profit of 10. So what you can see here is business A on the left actually has a higher profit of $20 compared to only $10 for B. Why? Because the cost of stock has risen, and that means that if we're selling the first stock first, and that's the cheaper stock, our profit's going to be higher. Let's follow this through and start with 2 units. So we sell 2 units at 60. The cost for business A will be $20, the first 2, and a profit of 40. Business B, that's $60 of sales. The cost will be the bottom 2 units, which is 40, and a profit of 20. 3 units are sold, that's a $90 of sales, a cost of $30 and a profit of 60. But for business B, $90 of sales, cost of 60 and a profit of 30. For 4 units being sold, we've got sales of 120, cost of 50. So this time we've got the first 4 units. So in this case, those 4 units there, that's $50, and that's a profit of 70. For business B, it's still $120 of revenue. But because we're doing LIFO, we're actually selling these more expensive ones first, and our cost of sale for that business will be 70, and that'll give you a much lower profit of $50. And finally, if we sold 5 units, that's the first 5 units, so we can see that equals a total here of 10, 10, 10, 20, and 20. That's $70, and that equals a profit of 80. And for business B, we've got $150 of sales. The cost will be 80. Why? Because we took the bottom 3 of 20 and then the top 2 $10 ones, and that'll leave a lower profit of 70. But then something interesting happens. When we sell all the units that we have, in this case 6, we get sales of 180, cost of 90, that's all the units together, for a profit of 90, and then sales of 180 for business B, cost of 90 for a profit of $90. So basically what's happened here is that the profits ended up the same. So if we looked at, there's the tables on the left of each business. Let's look at the net profit after each unit was sold. So after 1 unit, business A had made $20, business B had made 10. After 2 units, you can see business A had a higher profit. After 3, it had a higher profit. After 4, it had a higher profit. After 5, it had a higher profit. But then eventually when we sold all 6 units, both businesses rounded out with a net profit of $90. So the important thing here to realize is that you're going to make a high net profit in the short term if stock prices are going up. So what that basically means is that FIFO will increase net profit in the short term in times of rising prices. And so by that we mean price, if this is the order in which it came, was cheap at $10, and then stock as it came in later, because it was more expensive, it was $20. And what that means is in the short term, a firm adopting FIFO will actually have a lower cost of sales, and therefore it'll have a higher net profit. What's important to note that is in the end though, if we sell all the units, net profit will actually be the same.